From New York City, for our viewers worldwide, I'm Katie Greifeld. Bloomberg Real Yield starts right now. Coming up, a hawkish hold after 10 straight hikes, with Powell ruling out rate cuts for a couple years. As JP Morgan says, get out of the cash trap. We begin with the big issue, not done yet.
The markets don't really believe that the Fed's going to hike 2 more times.
The market, I think, doesn't believe that the Fed will come in with a second rate hike.
He can actually cut rates sooner than what people had originally thought.
I do believe what the Fed says.
I believe him.
Maybe it's not a question of belief, but relative positioning.
Powell actually, I think, did a reasonably good job keeping that hawkish option there.
I think twice more is not too high of a bar.
The market does not believe at all that the Fed is going to deliver those 2 hikes.
The market is thinking maybe this will be a shallower recession than originally thought.
There's definitely a feeling that the Fed is almost finished.
We continue to think that Fed is done here.
We're likely to have seen our last rate hike.
I won't be surprised if we get one more hike. Powell was unwilling to commit to July.
The Fed is very much undecided.
The Fed wants all options on the table.
The Fed has to sleep with one eye open well into the future.
Seeing is going to have to be believing.
Joining us now, we have Bank of America's Matthew Diczok and Collin Martin of Charles Schwab. And Matthew, I want to start with you. Okay, so we paused rates this week. We penciled in 2 more. When you weigh that against what we heard from Jerome Powell himself, what was your takeaway from Wednesday's meeting?
My takeaway is finally they're starting to get the market to be focused on how focused they are on getting inflation down. So much better than being too dovish for the market and misleading the market, being wishy-washy. You say, hey, we got 2 more to go. We're going to fight inflation. We're going to keep cranking rates to get this down. That's the right messaging. So much easier for the Fed to be hawkish now. Say it's not going to be 1, it's going to be 2. You know, manage expectations correctly, sort of overpromise on the rate hikes. And then if situation is worse than you expected, if they need to ease back, so much easier to set the market up or try to set the market up for more hikes and then bring it back down, as opposed to being too dovish. You know, inflation was transitory. Much better messaging, much better communication. This is the right way to be right now. Again, not saying it's going to be the correct policy going forward, but the messaging, in our opinion, is correct.
Okay, so you would give them a job well done when it comes to the messaging. That's interesting because I've heard a lot of dissatisfied people. Let's listen to what we heard from Torsten Slok of Apollo earlier this week.
If you think that inflation is too high today, you should probably be hiking rates today. So I think that the challenge really here is to say we'll get a lot more rate hikes. There was a lot of disagreement in terms of how many more rate hikes we'll get. But basically everyone says we'll have a lot more rate hikes. And if we do get 2, 3, even 4 more rate hikes, well, if there is so much worry today, why not just hike rates today?
And Collin, I want to come to you with that same question. Why not just hike rates today if you're maybe planning on doing it 2 more times?
Well, I think the key comes down to the plan and really the evolution of the data. We think the pause makes a lot of sense. We're seeing plenty of signs that inflation is coming down. But what we got when we take everything together with the statement, with the updated projections, and with Powell's press conference, we see a determination in the Fed to tell the markets, to tell us that they are fighting inflation and they're going to do what it takes to bring it down. So that's where all the hawkish sentiment comes in. Now, we're not convinced they actually need to do that. I mean, going into the meeting, we expected a pause and we weren't sold that we would get one down the road. We're still pretty much in that camp. I mean, I hate to use the term data dependency, but that's the case right now. If we see some signs of disinflation coming back down over the next month or 6 weeks, we think it's possible that they do stay on hold. But they're telling us that the door is open. They're committed to fighting inflation. But let's see what happens over the next 6 weeks or so.
Okay, so let's see what happened. We are going to get some key data points between now and the July meeting. Let's talk about the opposite of hikes, though. Let's talk about cuts, because I put this down in my notes because I wanted a timestamp on it. Powell did say that we're talking about a couple of years out for rate cuts. And Collin, when you think about where we are when it comes to inflation, do you agree with that time frame?
A couple of years, no. We've been in the camp that we wouldn't expect to see cuts too soon. When we were seeing cuts priced in for the end of this year and early 2024, that just seemed a bit premature. A couple of years seems too long, especially when you look at the Fed's own projections themselves. And that sort of confuses the issue a little bit, because if we're going to look at their projections for what they might do at the next meeting or so, we also need to look at what that means at the end of 2024, and we see a median rate of 4.6%. So when you take that together, a couple of years doesn't seem appropriate, but we do expect is for a prolonged hold or pause. So whether they hike again once, whether they do it by 225 basis point hikes, 150 basis point hike, we would expect a prolonged pause and hold to really see how this plays out. We think they'll take a patient approach, because the Fed's only going to cut if they need to, if they have to. And if the economy is doing okay, the last thing they want to do is cut rates, stimulate the economy, which would allow inflation to bubble up again.
Well, Matt, I'm excited to come to you on this question because I'm looking at your notes right now, and you write Fed 1, 2, 3 hikes from here. Who cares? 200 basis points of cuts coming is the main story. Tell us about what needs to materialize in this economy to see 200 basis points of cuts, and what time frame are you talking about here?
Yeah, that's right. So we spend a lot of time thinking, hey, pause, 1, 2 hikes. Now they should have done it now. They shouldn't do it later. These things around the margin are fun to talk about, but not the main picture. The main picture from our perspective is, as the yield curve has been telling you since November 2022, when Fed funds went higher than the 10-year rate, is that we're getting to the end of the rate hike cycle. We're late/end of cycle now. That is the most important point. Whether it's 1, 2, or 3 is not the most important debate. Now, as you pointed out, Powell had said that, it's a couple years away from rate hikes. Now, again, anything is possible. Futures always can be different than what we expect. But the market has been saying consistently for 7 months now, if you look at Fed funds futures or SOFR futures, that the Fed, wherever they get to the terminal rate, is going to start cutting, and it's going to cut about 200 basis points over the next year and a half. And so that's the main thesis we have here, that, again, we do have a forecast for 2 more hikes. Michael Gapin, our U.S. economist, did change his forecast. He pushed out his recession timing to the first half of 2024, but that's a change around the margin. He'd always said if there's any risk, it's a risk to recession a little bit later. The main point is we're getting to the end of the rate hike cycle. We need to think about extending duration, possibly moving from neutral to longer duration, possibly getting ready for those rate cuts that we expect after we pause into next year.
I mean, who am I? But 200 basis points of rate cuts in the next year and a half seems like a huge call to me. Collin, I got to get your thoughts on that.
Hey, it could happen. We share a lot of the same views that when the Fed tightens, things tend to break. And we do believe that the Fed will successfully slow down growth and inflation. So even though it seems like that first cut has been pushed back a little bit, we would expect a cut down the road because of all the tightening they've done. And we agree from a extend duration standpoint and what this means for clients. We've been hearing for the past number of months, Fed, what should I be doing with my holdings? Should I wait for the Fed to finish hiking rates before we consider locking in some longer term yields? And we agree that whether it's 1 more hike, 2 more hikes, or no hikes, that doesn't matter as much in the grand scheme of things, because we think the impact, the result will be the same, and that growth and inflation should slow. We'll see rate cuts, and then we'll see all yields fall. So we'd rather lock in some higher yields relative to the past 15 years with certainty, rather than face that reinvestment risk once the Fed does begin to cut.
Okay, I want to talk about that because both of you have brought up duration, extending out duration. And I talked to a lot of people who say, hey, cash looks pretty good here. If we have a Fed on hold, you're going to see short end rates probably stay up at these pretty high levels for a while right now. You have, no credit risk. You have no duration risk. I mean, when you're thinking about duration, Collin, why not just stay in cash?
Well, because we have to look down the road and what will the Fed do. So how much the Fed cuts in the next 12, 18, 24 months. We don't know what's going to happen, but we do have an idea because they provide their projections. We also have an idea of what Fed officials think that neutral or natural rate of interest is. And the long run rate appears to be in the 2.5%. So if the Fed can pull off some sort of soft landing and cut rates because rates were restrictive enough, they slowed things down and realized they don't need to keep it at such a restrictive level for so long, we can kind of earmark 2.5% as a logical landing place sometime down the road. Given that, we'd rather lock in 3.5%, 4.5%, which you'd have to take on a little bit of credit risk to get those sort of yields, but we'd rather lock in those yields rather than risk seeing that 2.5% in, say, a year and a half or 2 years.
Matthew, it sounds like that's your view as well. You know, lock in those rates now. Maybe it'll be a little bit painful in the short term, but not worth staying in cash.
So the way we think about it, we've been counseling clients to extend duration out to at least neutral. And officially, we are neutral right now, but we do have an eye towards moving longer duration from neutral, and we're thinking about that in the current context. The way we think about it is essentially people think, you were kind of highlighting the thought process there. Hey, you can get no interest rate risk and higher rates right now by being in the short end, cash. Like, what? That sounds like a great alternative. We feel that from clients a lot. They say, Matt, there's no risk here. I'm reducing rate risk and getting higher yields. What's the problem? And the problem is, and allow me to nerd out for a moment, it's Bloomberg real yield amongst friends here. the conservation of mass and energy, that mass is neither created nor destroyed. It's the same thing with risk. Risk is neither created nor destroyed. You're just switching the risk. So for those clients who are too much in cash, they're not reducing rate risk. They've replaced rate risk with a massive amount of reinvestment risk.
Right.
And when the Fed starts cutting rates, they can get much higher for longer if they extend out. So we really want clients to move out to at least neutral, get an eye to potentially go longer here as we watch the business cycle, because they'll get those higher rates for longer and they'll reduce reinvestment risk by taking more rate risk.
Guys, it pains me to say goodbye, but we're coming up against the break. Really enjoyed this. Matthew Diczok and Collin Martin, thank you. Up next, it's the auction block, and all the rate talk is causing a new trend to grow for bond sales. That's next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the auction block, where rising rates have certainly impacted issuance in a sign that bondholders are preparing for potentially more Fed hikes. Floating note debt sales this month are jumping. They currently account for around 4% of IG sales in the U.S., totaling more than $2 billion. Meanwhile, over in Europe, the market for the riskiest type of bank debt is back open for business 3 months after Credit Suisse's wipeout. Two lenders saw healthy demand. And here in the U.S., the uncertainty around the Fed and CPI caused issuance to miss weekly estimates. Volume finished at more than $10 billion, missing forecasts of about $15 to $20 billion. Meanwhile, JP Morgan's Bob Michael says that if the Fed is finally done, it's time to exit the cash trap.
If we're right, and we've seen the last Fed rate hike, and the market starts pricing in rate cuts, and they start cutting rates, then those cash returns will start to evaporate, and you'll have locked in not only the carry, but you'll get some capital appreciation from your bond portfolios.
Joining us now, Meghan Robson of BNP Paribas and Citi's Richard Zogheb joining me on set, which is a particular treat. I want to start with you, Richard. Let's talk about the cash trap, because cash has obviously been the place to be for well over a year now. Is it time to get out?
Well, look, I think there's some real attractive yield opportunities out there in credit. And it's really hard to pick the right time to move into those. But I would say that this is not a bad time to move into, whether, depending on your risk appetite, if you want to stay with something more high quality or even lesser quality, you're getting a decent return today. Both the high yield market and the investment grade market have returned nice numbers so far year to date. And if we do believe that rates are going to peak here and start to slow down, it would be a good time to move in and take advantage of that. It's just, again, it's impossible. I wish I could pick, figure out when the right time, the exact right time is. If I could, I probably wouldn't be sitting here. I'd be on a beach somewhere. But it does feel like a pretty attractive time to move into credit in one way, shape, or form.
Yeah, I've heard that timing the market is really tricky. I've heard that a few times. Meghan, what's your risk appetite?
So from our side, we are positioning for decompression. So we do think that investment grade looks attractive relative to high yield. Heading into the second quarter, investors were very risk averse, and you saw that in positioning as we've passed things like the debt ceiling, gotten some stability in regional banks, and then better data. Credit has rallied a lot, and especially high yield. So since May, high yield spreads are about 50 basis points tighter. Over that same time, IG is essentially flat. So we like rotating into IG. We think yields look attractive there, and especially for an investor in cash, you can't get a pickup in carry.
Well, we're just about halfway through the year, which means that it's mid-year outlook right about now. And Morgan Stanley released theirs, writing that, quote, "Our call is for wider spreads, further decompression, and muted excess returns. We favor IG over leveraged credit, prefer to own the front end within IG, and recommend adding CDX hedges." So, Richard, I'm curious to get your view there. Obviously, it seems like Morgan Stanley is looking at IG here. Meghan just said that she favors IG over high yield. Where are you on that spectrum?
Look, I think this is the first time in a very long time, probably since the great financial crisis, where I think you're getting a very nice return in the IG market, right? And what we're seeing is the traditional IG investor is flocking back into that market, right? Over the last basically 10 years, the pension fund, the insurance company that, the core of their portfolio has generally been IG. Those folks have been under pressure to try and search for yield, go into structured, go into more esoteric products, even dip down the ratings curve. And so for the first time in a long time, they can come into just regular way investment grade and get a decent return and good credit protection. So look, I do think IG is a very attractive place right now. The hard part about IG is we're having a very difficult time building and creating a supply that would actually meet all this demand. So I think you're going to be competing with a lot of folks for product, which could compress spreads over time. But for the time being, IG is very attractive. Look, if you think about leverage, and I don't disagree with what Meghan's saying. Right now, leverage has performed very, very well, as she mentioned. And we think that's going to continue for a period of time, but it's not going to continue forever. There's a big maturity wall that starts in late 2024, continues throughout 2025, and even slips into 2026. A lot of those companies would have a very difficult time refinancing those maturities in the current rate environment. A lot of them are employing the often utilized, never really effective strategy of hope and hoping for rates to come down. If that works out, great, then the leverage markets will do very, very well. If it doesn't, you could see some problems starting kind of mid next year in the leverage markets.
Well, talk to us about the maturity wall, Meghan, because I don't know, I hear it come up every now and again. It sort of reminds me of the debt ceiling, where it's sort of always kind of okay. Are you worried about the maturity wall this time around?
We are worried about it. We think it becomes greater of a risk heading into third quarter of this year. So from our work, we see the maturity wall increasing pretty materially in 2025. Issuers tend to be about 12 months to 18 months forward-looking in terms of refinancing maturities. And so as those start to come into view, we do expect that refi risk will start to rise for high-yield issuers.
Well, let's also talk about default risk, because there was a really interesting report from Moody's out basically saying that they see the global high yield default rate hitting 5% in 2024. We have some bullets there. The long-term average, for context, is 4.1%. So if we got to 5% by April 24, which is what they expect, that would be quite a dramatic pickup. And Meghan, when you're thinking about the risks, the maturity walls, downgrade risk, default risk, I mean, where does that leave you within the IG market?
So it does lead us to preferring IG, but similar to Moody's, we expect defaults to rise. We expect that to be a gradual increase. The fundamental deterioration has started to play out, and we've seen that in interest coverage ratios, which have started to fall. As that process continues, we expect a gradual ramp up in defaults. I think what's going to distinguish this cycle is it will not be as dramatic of an increase as during COVID. So 5% is lower compared to the 8% in COVID, but we could stay there for a longer period of time, given that this time around the Fed is not going to be able to necessarily cut right away.
And I'd like to weigh in on that. I think I agree. I think it's going to take a while to get to that 5%. Not because there aren't companies out there with stressed capital structures. There absolutely are. There's just so much money in stressed and distressed investor hands. And that money is searching for higher yielding, higher risk opportunities. And I think you've seen that with, not to pick on one company, but Bed Bath & Beyond should have probably filed for bankruptcy a lot sooner than it did. And the reason it didn't is because you had these stressed investors who were desperate to find places to put money to work that were willing to take even more risk. And I think that dynamic's going to play out and cause the default rate to take a while to get to that 5%, but once it gets there, I agree with Meghan, it's going to stay there for a while because there are a lot of companies with very stressed capital structures, and once the stressed and distressed investors sort of pick through the bets that they want to make, whatever's left will probably hang around for a while.
Well, hopefully we can pick through those names together again, but we got to say goodbye for now. Really appreciate your time. That is Meghan Robson and Richard Zogheb. Thank you both so much. Thank you. Still ahead on this program, though, it's the final spread. The week ahead, Powell heads to Capitol Hill. That's next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the final spread. The week ahead coming up. Markets are closed on Monday for the Juneteenth holiday. More Fed speak on Tuesday with Bullard and Williams. Then on Wednesday, Chair Powell begins his two-day semi-annual congressional testimony. Thursday brings the BOE's rate decision. And then on Friday, we'll get U.S. and European PMI data. But let's talk about Powell because his testimony is likely the event to watch. There was some mixed messages coming out of this week's presser. Of course, we held rates, but also penciled in two more. So we'll see which way the market takes him when he talks next week. But from New York, that does it for us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.